This is a look ahead to 2026 from an FX perspective, part of a series of videos I'm producing in the lead up to a year ahead webinar on the 12th of January. And so let's take a look at exactly what the performance has been for some of the top performers and underperformers of 2025 and what we can expect for the year ahead. So first and foremost, this is essentially the scorecard to close out the year, looking at the outperformance of the Russian ruble, the underperformance of the Argentine peso, but looking at currencies that people are generally trading more often, the Swiss franc has been the outperformer. Notably, that's something that I've been talking about for quite a while now, and that is that the Swiss really got ahead of it when it came to drawing rates back down to normalized levels. From their perspective, that's much below many of the other central banks. But certainly the fact that the SNB cut early and moved ahead of time means that we then saw the strengthening of the Swiss franc as other central banks started to cut rates. Now, the Eurozone did a similar kind of thing at the ECB, and you can see the Euro heading things up in terms of the strength of the Euro, in part because they front run the easing process, and we saw some of the other currencies start to weaken against it later on in the process. At the bottom of the pile, yes, you've got the sort of struggling currencies, the likes of the Argentine peso, the Turkish lira, but we've also got the likes of the Japanese yen, which certainly we've grown quite accustomed to losing ground over the years. But we're seeing some question marks coming into that as we move towards a phase where we're seeing additional tightening from the Bank of Japan. But in terms of the year ahead, one of the key things to be tracking is going to be the US dollar. Now, when we're talking about the FX markets and you look at the majors, pretty much all of them have got the US dollar in it. So the dollar, not dollar denominated, but the dollar associated FX pairs will typically be the main ones people are trading. And so if you know where the US dollar is going, then you're going to know where pretty much all of the FX majors are likely to go. Well, where has it gone? And under Trump, it's gone down. We've seen a significant deterioration in the value of the US dollar. As you see, from up 5 to down 5, it essentially lost 10% of its value. This is the dollar index following Trump's election in 2016 and 2024. And it's remarkable how similar this is. This is a chart I've been showing sort of in the immediate aftermath and the lead up to his election win, but didn't necessarily think it was going to play out as perfectly as this. And certainly the way that it's starting to roll over certainly would be indicative of another leg lower for the US dollar in the coming months. Where we go from there remains to be seen. We don't have many examples of a term where the president essentially leads to the deterioration of the US dollar throughout the entirety of their tenure at the White House. So do we see another leg lower and then we start to see the bullish phase coming back into play? Potentially. I mean, look, the way that I think that we might see devaluation in terms of the US dollar over the sort of nearer term is the perceived shift in terms of the Federal Reserve from what markets are currently pricing 1 to 2 rate cuts for next year and towards a period where we see additional easing that perhaps isn't justified. The idea of a non-independent Federal Reserve does bring the possibility of significant downside for the US dollar. And ultimately, a weak dollar is beneficial for Trump's policies. So he wants to see the US dollar pushed lower. The caveat here is, of course, he also wants to eradicate trade deficits. And if you see a major shift towards people importing from the US and perhaps exporting less to the US, then it means additional demand for the US dollar and a reduction in terms of selling of the US dollar to buy currencies abroad to buy their goods. That provides the potential basis for strength for the US dollar. And then you have the possibility of outperformance in the US economy as we go forward. That again would provide the potential basis for upside. So there is a possibility this could play out fairly similarly. And certainly I wouldn't put it past the US dollar to see some weakness in the period ahead as you see it rolling over. Now, one of the key areas to sort of look at when you're considering the trajectory of FX markets, because it's trading one currency against the other, will be the relative rates of the central banks. And by proxy, yields, you can look at something like the 2-year yield. It gives you an idea of not only where rates are, as we can see here, these are the rates of the central banks, but yields will also reflect market shifts in terms of the perception of where rates are going to go as well. So it can be even more useful comparing, say, the 2-year yield in the US versus the 2-year yield in the Eurozone or in the UK. But nonetheless, the way that I see this in terms of potentially driving price action is what central banks have finished their easing, what central banks are predicted to do more, but perhaps not as much as is actually the reality. I think if you look at the central banks that have still got further to go, you look at the top rung here, and essentially it's the likes of the Bank of England, it's the likes of the Federal Reserve and of the RBA. Now, the RBA, I think, is a bit of a different situation because we've actually seen inflation on the rise. Remember, the Australians generally rely on quarterly inflation, but more recently we've seen them introduce this monthly method, and you can see it moving into the high 3%. The latest RBA minutes signal that they're going to have to be cautious. So I don't expect too much in terms of additional easing from the RBA. So that points towards maybe not the weakness for coming for the Aussie dollar, but certainly within the US dollar, because of the idea that we might see the Fed continue to run it hot by cutting rates, especially as we see Donald Trump replacing the Fed chair in May. But also in the UK, there's still a fair amount of easing left to go if you're going to get back towards the levels that we're seeing for some of these other central banks. But bear in mind, UK inflation is actually moving meaningfully lower. And in particular, when April inflation drops out from last year and is replaced, I think there's a good chance we get much closer to that 2% target. I think the current outlook in terms of easing from the Bank of England isn't likely to be the be all and end all. So I think there's going to be additional pricing for easing from the Bank of England, which should provide weakness for the pound. And you can see that here. So one way to track these relationships and movements is you can go onto TradingView and you can say, okay, what's the 10-year yield on this example of Germany minus the 10-year yield of the UK. So what's that differential? You plot the currencies that are relevant to the two markets, and you can see that the relationship is generally tracking and correlated heavily with the bond market and the FX markets. So if I expect the ECB to essentially be done, and I think that the Bank of England not only are going to cut as markets expect, but actually do more than that, and therefore we expect a repricing, that would point towards further upside potentially coming into play for euro sterling in the year ahead. Like I said, the Australian dollar, I think, is likely to remain strong if inflation remains elevated. And so that doesn't necessarily mean weakness. It could mean the potential for, say, weakness for the pound against the Australian dollar. It's a different way to play it. And then you have some of the other areas that perhaps we've been seeing significant sort of volatility in, the likes of the yuan, the likes of the Japanese yen. So sort of Asian currencies, I think, are going to really come into focus. We've seen a significant deterioration in terms of the yuan. Many are calling for a resurgence into the terms of the yuan. From an economic perspective, the Chinese economy appears to be in good shape. From a trade perspective, and therefore demand for the yuan, things are certainly looking pretty good. Certainly the US-China relations have improved, and the Chinese have managed to find alternate markets as well. They're also building markets like the trading of gold in Shanghai and things like that, people pricing, say, oil in yuan and deals being done in yuan. It is essentially turning into the proxy currency for many of these BRICS nations. So look out for a potential resurgence for the yuan. And the last one would be the Japanese yen. Make sure to keep a close eye out on the Japanese yen. We have seen a devaluation down to, well, essentially, it's not down to, it's up to, where are we currently? We're currently at 156. We did get close to 158. So essentially, you're seeing a weakening of the Japanese yen, but that may not necessarily last forever with the fact that they're hiking interest rates. Certainly keep an eye out on yields as they continue to rise. You see the possibility of a snapback where people repatriate assets back into Japan. And at the same time, you're looking at a perception of potential weakness for the US dollar over the near term. So keep a close eye out for the Japanese yen, the Chinese yuan, the possibility of intervention in Japan, whether it's the BOJ or the Treasury, does provide the basis for a possible move higher for the yen. But certainly there's a lot of question marks at the moment around whether the carry trade is going to blow up. At the moment, it hasn't. But if we did see that turn around, then that could cause some serious consternation within markets.